Hey everybody, Jeff Dorman, Chief Investment Officer at Arca, back again for another edition of That's Our Two Satoshis Live, where we talk about everything that's happening in the digital asset market. I'm joined today by my esteemed colleague, Bodhi Pinkner. How are you, sir?
Hey guys, how's it going? How's it going, Jeff?
Long-time listener, first-time guest. So he's excited to be here. You can see in his smiling face, he's excited to be joining me on the show here. For those new, obviously we write a blog every week called "That's Our Two Satoshis." You can find it on our website ar.ca/blog. But some of the things we were talking about this week, and we'll go slowly into it in a second, was just talking about, is this a real rally? And if so, is this another one of those hated rallies like we saw in 2020, where everybody is either short or too long cash to appreciate it, or if this is something that's a little bit more has a little more legs behind it. And then we also talked about transparency and what we're seeing after the carnage of Celsius and Voyager compared to that of our DeFi and blockchain counterparts, where you can find all that information. So let's start with the top, Bodhi, talking about the market rally. And what I wrote about last night and that we released today on our blog was kind of the mixed messages we're getting in the market right now, right? On the one hand, we still have a macro-driven market where Bitcoin has very high correlation to growth stocks and everything's kind of moving together. But on the other hand, we saw pretty big dispersion within digital assets, right? So while Bitcoin was kind of stuck and just chopping along with equities, we saw some pretty big moves over the last 3 weeks from DYDX and Curve and Uniswap and Lido and Atom and Ape and you name it. What are you seeing there in terms of the actual events or catalysts that are driving some of this outperformance?
Yeah, so one thing we saw was increased transparency and likelihood around the Ethereum merge date. I think that was one of the first things that started to kickstart, Ethereum's outperformance versus some of the other L1s. But the other thing we're seeing is after the Celsius forced liquidations and 3 hours forced liquidations, even though this isn't a fundamental driven market yet, you started to see a lot of tokens who on a fundamental basis, whether that's price to earnings multiple, price to sales multiple, started trading in their historical lows and even lower than value equities. Call it like 2 times earnings to 10 times earnings. So I think you started to see some, investors who are aware of fundamentals or believe that fundamentals will eventually matter, start to go out on the risk curve there.
Yeah, I think that makes sense too. And when one of the things that's challenging as a fundamental analyst in this space is you do have to make some forward-looking assumptions, right? We know everything right now in the digital asset world is somewhat isolated to its own little microcosm, right? There's not a lot of influences from the outside world. So, for example, even though all you hear about is recession talk, we don't really know if a recession matters in terms of how it affects digital assets, right? Most of these companies don't have cost of goods sold, right? They don't have physical rents or locations. They don't have physical inventories. It's very different. We've never been through a recession. We're not 100% sure how it's going to affect a lot of the tokens and the companies and projects that issue those tokens in the space. But we do know that it's very highly levered to just user growth and transactions, right? Whether you're playing an NFT, a game, whether you're playing a blockchain-based game, or you're transacting in NFTs, or using a DeFi application, it all does come back to, are people using digital assets? Are they transacting? Are they interested in trading? And as a result, when we look at some of our fundamental forward-looking valuations, we do have to make some assumptions about some sort of a normalized growth rate, right? When you see, for instance, Bodhi, when you see transactions dropping 70 or 80% or volumes dropping 70, 80%, how are you thinking about kind of normalizing those models to something that makes sense on a go-forward basis? So we're not just trying to model out and extrapolate. Like, for example, if you extrapolated September, October, and November of last year, you'd think crypto was going to grow at 1,000% annual growth rates, right? If you extrapolated the last 2 months, you would assume that crypto is going to die. Neither of which is true, and we have to come up with some sort of a medium ground for what the true expectations are for these volumes and revenues and cash flows of these businesses.
Yeah, so we approach it. We like to apply a sort of a sensitivity to it. So in our sensitivities, when we're trying to understand like where a token might be trading 3 years from now, what the fundamental metrics might look like, we typically have 3 cases. The first case is going to be a bear case, where we either see volume retraction even from these depressed levels. The second case is going to be sort of a base case, where we see some sort of reversion to the mean, whether that be to pre-2021, late 2021 bull market volumes, And then the third is going to be a high growth case where we exceed that 26% projected compound annual growth rate for the entire crypto space as a whole. So I think when you have, in summary, when you have such a volatile asset class and such a volatile user base, you have to understand like the range of possible outcomes and then go from there.
Yeah, I think that's right. And in terms of what we said at the beginning of the hour here about whether or not this is a real start of a rally or if this is, just a head fake. Now I look back at something we wrote in April of 2020. So historically now we can look back at April 2020 and realize that that was the start of a real rally, right? We had a 10-month straight up move in digital assets after the March 2020 carnage. So I went back and reread, and I posted a link to it in the blog as well about what the market conditions looked like in April 2020, and is that similar than we see today? And part of it actually is very similar. For example, we had leverage just wiped out in March 2020, right? When BitMEX shut off their liquidation engine and there was just cascading futures liquidations for 3 straight days. All that leverage was gone. And as a result, when you started to see spot buying in April 2020, it became pretty sustainable and we moved pretty fast on the way up. Same thing's happening right now. The leverage got wiped with the 3 Arrows blowout and the Celsius and Voyager blowouts. And now you have some real spot bidding, which is driving prices higher. Similarly, the cash balances were extremely elevated. Back in April 2020, everybody moved to cash or even started shorting. The same thing is true now. The overall digital asset ecosystem is now right around $1 trillion. But we've got almost 200 billion of stablecoins sitting there in cash ready to be deployed versus 2 years ago, it was only about 30 or 40 billion of stablecoins. You have a huge cash coffer sitting there waiting to be deployed. And that's true in equities as well. The Bank of America survey of their clients recently indicated that equity allocations are the lowest since 2008 and the cash balances are highest since 2001. So there's a lot of cash sitting there. 3 is sentiment, right? I mean, I think you don't have to look very far to realize that sentiment is at the absolute lows right now, whether it's the fear and greed index or just crypto Twitter or anything else you're looking at. People are not very bullish on any risk assets, which tends to lead itself to a pretty big reversal if and when there's reasons to buy again. And lastly, and I think probably the most important is small caps are really outperforming Bitcoin. Typically, when you start to get some legs to a rally, you see some of the smaller, sector-based digital assets start to outperform Bitcoin. And we're seeing the same thing in April 2020. We saw, many coins start to rally long before Bitcoin gained traction again. We're seeing the same thing today. We already mentioned a few of them, whether it's Lido or Atom or Axie, Ape, Maker, Curve, Matic, you name it. All these tokens that are up 30 to 100% from the lows, while Bitcoin's only up a good 10, 12% from the lows. So I think the big difference, of course, is that the Fed was very accommodative and supportive back in April 2020, whereas now they're going the other way. But conversely, none of the things that have made digital assets what they are today existed 2 years ago, right? We didn't have huge stablecoin growth and huge DeFi activity and NFTs. So you got competing forces. I'm not 100% sure if we're out of the woods from a macro standpoint, but I definitely think this rally is probably more real than most people think it is. So we'll see what it looks like over the next few weeks or so. All right, Bodhi, moving on. One of the things that I have been a big advocate of since really inception of Arca almost 5 years ago was the idea of more transparency. For those of us who have lived in 2008, 2009, we saw just an amazing amount of distrust with the banks and governments because nobody knew what was going on. Nobody knew who had CDS exposure or mortgage exposure, et cetera. And then, of course, 15 years later, all we did was recreate the same thing in digital assets, right? Nobody knew exactly what Celsius's exposure was. Nobody knew exactly what Voyager's exposure was, or 3 Arrows, or Genesis, you name it. I, for one, have been pouring through the bankruptcy docs, Voyager and Celsius's recent bankruptcy filings, and it's pretty frustrating, right? On right away on the first day filings, Celsius puts out their liabilities and assets. You can see exactly how big of a liability asset mismatch they have in terms of what they owe versus what they have on balance sheet. You can also get pretty good details into the liquidity picture, what they owe to customers today versus, what their assets are from a duration standpoint. Why the hell is this stuff not available in real time before it becomes too late? And I started thinking about all the different ways where this is true now. So, on the negative side, you have the centralized lenders and the centralized exchanges, which don't really tell you anything about their businesses. But on the positive side, you've got stable coins and their new attestation reports, and really everything in DeFi. And I started pulling up a lot of Slacks that you've been sending me internally about, Maker's dashboard and Aave's dashboard. Like, where are you getting this real-time information from? How important is it to you as an analyst? And why do you think more companies and projects aren't transparent with these dashboards, or setting up a Dune Analytics dashboard, or getting plugged into Token Terminal, et cetera?
Yeah. So to answer the first question, I think there are two levels of transparency with these DeFi protocols. The first level of transparency is just on chain. Every single loan that they loan out is available on chain real time. You can see, exactly what address is borrowing and in what quantity, what collateral assets they have against that loan, and then where their liquidation levels are. So that information is made available by certain data aggregators, such as Parsec and Token Terminal. But also the more savvy individuals can go into Etherscan or a different blockchain explorer and just see all the metadata that available there. The second level of transparency is a lot of these DAOs are actually issuing formal reports either on a monthly or quarterly basis. And there, you get into the grains about like the profitability of the protocol, some of the various growth vectors that they're trying to tap into and whatnot. So that's the interesting thing about some of these blockchain protocols. Whereas with traditional equities, you receive information once every quarter, and they're as transparent. They try and minimize their transparency typically as much as they possibly can under GAAP reporting standards. Versus these other DeFi protocols where you can actually get data on a minute-to-minute basis if you so desire.
Yeah, it's almost like getting an 8K every day. One of the things that I thought was interesting is, everyone got up in arms about Tesla selling their Bitcoin, right? They sold almost $1 billion of their Bitcoin holdings off of their corporate balance sheet. But what's more interesting is that those sales happened in somewhere around April and May, right? Just judging by the exit price that they got, we don't know exactly when it was, but it was somewhere around April and May when Tesla did their Bitcoin selling. The market didn't find out about it until last week, which is now middle of July. That's crazy to think that, we're talking about the real-time reporting and the advocate, why the blockchain is so important as a, public, transparent database. And here we are 3 months later finding out about $1 billion sale because they had to report it during, a standardized report for a quarterly release of a public company. Like, that's crazy to me when you consider the alternative was everything Celsius was doing in real time. People were watching, right? We could see exactly which wallets they were selling out of, how much they were selling. There's pros and cons to it. But I think there's more pros than there are cons, right? The ability to understand what is happening as it's happening prevents a lot of the problems we've seen in traditional markets, right? There's a reason Bernie Madoff was able to get away with what he did for as long as he did, right? There's a reason, a Theranos was able to get away with as much as they did, is because there was no way to really see what they were doing until it was too late. And I think the same thing is true of Celsius and Voyager, right? No matter how much you try to know what was happening there, you just didn't know until they were forced to reveal the information in bankruptcy. I think the exchanges, for example, are another example where they could do a better job. I think exchanges owe it to customers to be more transparent about their listing process and about, if they're going to list a token, what is the supply schedule? What are the token unlocks? I think in general, what I've learned over 4 or 5 years doing this now is that most people just are used to the way traditional finance operates with your quarterly reports, your 10Qs, your 10Ks, your 8Ks. But if presented with a better alternative, almost everybody would say, yeah, that's better. It's way better if you could tell me the information in real time rather than making me wait 3 or 4 months. And I think it is, it's really interesting to me that this system now exists, right? We have this blockchain technology and these protocols that allow everybody to be on the same playing field. And there's just not enough people using them, right? And the irony, and this is obviously a touchy subject because I'm sure just like us, everyone feels terrible for anybody caught up in the Celsius and Voyager bankruptcies. But the irony is 3 of the assets that you could have pledged to Celsius or Voyager were assets like the Aave token and the Maker token and the Compound token. And it's like, okay, if you knew enough to buy those tokens and invest in those tokens, why not go a step further and learn how to actually use those protocols? And had you parked your assets with them instead of a Celsius or Voyager, you'd still have 100% of your assets. And I think that's what I want to know is like, how do we get to that next level, which is not only transparency, but people understanding how to read the blockchain explorers, why this is a better system, why this is actually safer in some ways than these opaque centralized systems.
Well, I think there's 2 things. I think one of the barriers to entry is still probably fiat to crypto on ramps, it's very hard to get money into the system and then get that money out of the system and spend it on real world goods and services. The second thing I think is just like if you mirror the adoption of the internet, 10 years ago, very few people knew, I don't know, how to peruse Google or how to, create a spreadsheet online and send it to 50 of their friends. But over time, network effects start to take hold, and those who are using those tools, if they receive net benefit from them, refer a friend, and eventually, you're forced to use it if it is actually an improvement over, traditional goods and services.
Yeah, I think that's right. So obviously, at Arca we have the means and the tools to pull a lot of APIs directly. But how would you, when you first got into the industry, or when another analyst comes in for the first time, what are some of the tools that you would use first to learn how to read a block explorer, to learn how to find some of this information? Is it? I already mentioned Dune Analytics, for example, which I think is a great resource. But what are some of the other resources that you're using to pull this transparent information?
Yeah, Dune Analytics is good. Just to list them off: Nansen, Token Terminal, Parsec. I think those are the big ones. Those are our most frequented for sure.
Yeah, and a lot of it comes from just getting in there and trying, right? I mean, again, some of these tools have really good user interfaces. Like, for instance, I find Token Terminal to be one of the best user interfaces. You can see very clearly, revenue data, user data, et cetera. Others like Etherscan, for example, which is a block explorer, is a little harder, right? It doesn't look clean when you go in there. You kind of have to poke around and play around with it and see these transactions. But also, shout out to a lot of the people on crypto Twitter who do this for a living and post things in real time when they see it. There's a lot of great on-chain detectives out there that are finding information and passing along to the community. In fact, some people may have seen that a couple of Coinbase employees were charged with insider trading and wire fraud this past week. That was identified within hours of it happening by a Twitter handle at Kobe, who saw the transactions happening and said, look at this. We can see right away that all these tokens that were about to be listed on Coinbase had hundreds of thousands of dollars of transactions in them on chain. So really, I think you're right. There's enough people out there who know how to find this information now, and there's enough ways to pass that along and create those network effects so others can learn, to the point where you just can't hide anything anymore. Which begs the question: why the hell is anybody still trying? Right? Why are people and companies still trying to hide this information rather than owning up to it and putting that information out there? So again, I mentioned MakerDAO and Nexus Mutual and Aave, a couple of the projects that we like that are, very transparent with their information. I know there's, plenty others as well. Is there, maybe did I miss a few? Are there any that are pretty good with transparency right now in terms of putting information out there, whether it's monthly or quarterly or ways for investors and customers to digest that information?
DYDX is pretty good as well.
DYDX, yeah. So shout out to those who are already doing it. We encourage customers of these platforms to make noise. Tell your favorite companies and projects that you want to see more transparency, that you want them to put this information out there. I think the onus really is on the community members to force this transparency from the exchanges, from the lenders, from the protocols, from everyone, because again, this information is ubiquitous. It's out there. It's just a much better financial system when everybody's on the same playing field and not waiting 3 months or years to get information. So I encourage everybody to read the blog. Again, it's ar.ca/blog. Send us any questions, any thoughts you have on what we've uncovered in here versus what you've seen in terms of transparency or lack thereof. You can follow Bodhi on Twitter. Where can people find you on Twitter, Bodhi?
I think it's just Bodhi Pinkner.
There you go, with confidence. I think it's Bodhi Pinkner. There's not a lot of Bodhi Pinkners out there. You can find him on Twitter at Bodhi Pinkner. But send us a line. Let us know your thoughts. Appreciate the time today, and we'll be back again next week. Thanks for joining, Bodhi.
Thanks, Jeff.